Hello everybody, my name's Nathan Pryor. We're going to get started now. I think we'll continue to let people join as they connect in, but for everyone's time we'll get going. So welcome everybody to today's session, which is focused on retirement planning for US taxpayers in the UK. Can I just ask that everybody make sure they keep their microphones muted and be aware that this session is being recorded. We'll send around at the end a link for everybody so that they can view back their favourite bits at the end. If you have any questions along the way, please do type them into the chat box and we'll aim to answer as many of them as possible at the end. Now, in today's session, we're going to have a very brief recap on the hurdles for US taxpayers in the UK. But we're not going to go into huge amounts of details there, and we'll refer you back to previous webinars or guides that have more detail on this subject. Of course, please do reach out to anybody on the session today should you need further information. After that quick recap, we're going to look into the detail of retirement features in financial planning and introduce some of the key considerations with regards to UK pensions and US retirement plans. Gillian, our guest tax expert for the day, will provide us with some details on the tax position and the reporting requirements of those US and UK considerations, and also introduce some other related concepts that you might want to think about as well. We're going to move on to have a look at how to invest for retirement. And I'm going to ask Brian to give us some insights into how Dunhill Financial manages retirement portfolios and investments for US individuals directly. We are, of course, also delighted to welcome back Marylouise from American Citizens Abroad, who will give us an update on the advocacy efforts that they are getting involved in and touch on some other helpful resources that they have for you. Again, please do put any questions that you might have in the chat box and we will aim to answer those at the end. And do remember that this is an open session, so just be mindful not to disclose any information that is personal. Of course, if you do have personal questions, any of the speakers here will be delighted to discuss that with you individually at a later stage. So, as promised, I'm not going to spend a huge amount of time recapping on the hurdles and backgrounds today, but just give you a brief reminder. A US person, and be that a US citizen, a green card holder, or indeed a child of a US citizen, as one of these people, you are required to report and pay taxes in the USA, regardless of where you physically reside. Now, fortunately, there are tax treaties between the USA and the UK, which mean the potential for double taxation is limited. However, you do have to be mindful of not making mistakes and making sure that you do the correct filing for these limitations to be in place. Some of the key things to note and be aware of will be things along the lines of there is probably a form for everything. Even if you think it's not relevant and there's no tax payable on something, likeliness is there's a form that needs to be completed to inform somebody of it. So always be aware of that and ask for assistance if needed. The other key things that everyone should be aware of are things like UK investments will most likely fall foul of US PFIC rules, and US investments will tend to fall foul of UK offshore fund rules. The other item is currency, which is often forgotten because it can often make a meaningful impact to your taxable gain position, either making a loss gain in one currency rather than the other, or indeed making a gain larger than you think it might be. Another item that we just want to touch on and highlight, which everyone should be aware of, is that global cross-border transfer of information is stronger these days than ever. That means the tax authorities have all the information they need or can easily get it on request. Therefore, The most simple advice I can give is to try and keep up with your reporting, and if in doubt, do engage advice as early as possible. Now, with that said, it might be easy to say this all sounds a little bit too complicated, so why do we bother? However, in actual fact, if you do follow the rules, work within the guidelines, and perhaps engage with some professionals to assist you, there is no reason why a US taxpayer in the UK cannot use efficient planning and tax advice to reach their financial freedom and invest in an efficient manner. Now, I say financial freedom, and that's what I've kind of focused on in this slide, because financial freedom is ultimately what we're all aiming for. For some, that freedom might be to retire, but for others, freedom might be to change career, or freedom to help their children more, freedom to travel or buy a second home. Financial planning in its whole is about helping individuals find that freedom. Of course, it can be broken down into many stages, as you can see in this timeline here. Now, don't worry, I'm not going to go into each one of those because this session is focused on retirement and pensions. However, it is important to consider that for planning your retirement, it's just the one element within that holistic financial plan. And that first you might want to start with things like ensuring that your immediate needs are secured, that you've protected your family's well-being, and that you've got a balance between ensuring your near-term requirements are met, as long as focusing on those longer-term goals and objectives. In fact, we often work with individuals who are nearer the start of their financial plan and trying to work out how much they need to hold back in short-term savings, perhaps for things like education expenses, versus planning for and putting aside funds for that longer-term objective, like their retirement. If you build out and map out a financial plan, that will enable you to have a discipline in how to use your savings and investments, with the knowledge that by doing so, you're moving towards your short-term and your long-term objectives. And you can use that planning to test things, to optimize your personal position and make sure that you're using all the right tools at your disposal to optimize your position in meeting those long-term objectives. Now, if I was to give you the ultimate tool within planning, and we think about what that tool might be, we might think of a savings account where you can get upfront income tax relief on contributions, you can get tax-free growth on the investments that you've made, tax-free withdrawals whenever you want it, and tax-free death benefits. I think we all might say that that sounds pretty good. Now, a UK pension doesn't quite tick all of these boxes perfectly, but it does come quite close in a number of scenarios. First of all, you can make tax-free contributions or get tax relief on your contributions. However, there is a limit to that, which is in the form of the annual allowance, and that will taper down for higher earners. The next on our wish list is tax-free growth. Again, a UK pension can give you that. There is, however, a thought that you need to be aware of the overall lifetime allowance in pensions, which is not just related to your contributions, but related to the overall value that your pension can reach, including the roll-up of growth. The next item on our list was tax-free withdrawals whenever you want, and this is perhaps where pensions fall down a little bit. Firstly, withdrawals are limited until after age 55. However, you are able to take up to 25% of that as a tax-free lump sum in the UK. Thereafter, income that you take from that pension is going to be taxable, but it is flexible and you can take as much or as little as you like. Now, as a US citizen or a US taxpayer that's come to the UK, you may well have also accumulated some US retirement savings, or you might be wondering whether you continue to contribute to your US retirement savings. Now, the answer to that is maybe. I say maybe because you can contribute or not to a US retirement plan, very much dependent on what your filing status is. And of course, that's probably something that you want to discuss further with your US tax filer. However, there is generally some potential for people to contribute either to a traditional or perhaps to a Roth IRA, again, up to some limits. Traditional IRAs are possibly the closest one to a UK pension, in that there is scope to get tax relief on contributions, and that the future drawings are most likely to be taxable depending on your income levels. A Roth IRA, however, is the inverse of that, where you're getting no upfront tax relief, but you do therefore have the ability to withdraw from that retirement account in future without tax being paid. And perhaps that's seen as being a little bit closer to the UK's ISA rather than a pension scheme. Now, in both of these scenarios, growth can be rolled up tax-free within the account. However, when it comes to withdrawals, you should be aware that if you make withdrawals before the age of 59.5, there will be a penalty of 10% on that value. Another notable difference between the two is that a traditional IRA has a requirement to start making distributions from age 72, whereas the Roth does not. Now, because of these differences between the two different types of plans here in the US that we've focused on here, there will be times when you want to consider which one is correct for yourself. And indeed, there might even be times in the future where you might want to consider rolling your traditional IRA into a Roth IRA. Now, it's at this point that I'll take a pause and hand over to Gillian, who will have a look at these and go into a bit more detail on the specific tax aspects that you would want to consider if using any of these plans.
Yeah, thank you very much, Nathan. Cam, if I could ask you to unrestrict my video, please. Yes, as I said, thank you, Nathan. My job in today's presentation is to build on some of the key things and put a bit more flesh on the bone, so to speak, of some of the points that Nathan's very helpfully already dealt with for us this afternoon. As Nathan started his part of the talk mentioning, a lot of what US citizens need to deal with when considering retirement planning as a UK resident is all about making sure they're very confident with their reporting position in both the UK and the US, depending on the pension schemes that they want to continue to contribute to. So we'll deal with that and look at a bit more detail as to how the double taxation agreement that Nathan's already referenced for us allows us to continue to contribute to existing pension schemes in both jurisdictions. So looking first at the tax considerations of UK pension schemes, obviously we all know that a US pension scheme is absolutely fine from a US citizen reporting in the US perspective. But what about a UK pension scheme? Do I get tax deductions, and how do I report that? So the short answer is, as a UK resident, US citizens, as a result of the double taxation agreement, you will get a tax deduction in the US for all contributions made to UK pension schemes within the normal limits that you would expect in the United States. At times, and I'll come on to this in a bit more detail as we go on, it may be possible to contribute a little bit more than the US allowances if you have higher allowances available to you from a UK perspective, and it would help your UK tax position to be allowed to put in a little bit more up to the UK allowances, which Nathan's already referenced for us. From a UK perspective, obviously, we know what, as Nathan said, what the limits are on what we can contribute to a UK pension scheme. So that's obviously from a UK perspective, very straightforward. Looking now at US tax considerations on UK pension income when we come to draw on our pension income in retirement, under the double taxation agreement, they do resolve quite successfully where your primary tax home, where your primary tax responsibility for that pension income is. You start from a base that, as a US citizen, you're taxed on a worldwide basis. So obviously all income is reportable. So the US, the UK tax, the UK pension income does need to obviously still be included on your US return. But as a result of the double taxation agreement, what will happen when you're considering employer or personal pensions in the UK is that you will be allowed to take a foreign tax credit in the US for UK tax that will be due on that UK pension income. So there won't be any double taxation there. As I say, you will have to report it, but there won't be any tax implications from a US perspective. Other reporting considerations from a US perspective in respect of UK pension schemes can include a lovely form called 3520. The 3520 applies to UK private pensions, and it's been a subject of some debate over the years as to whether this is necessary, but due to the potential penalties, it certainly should be explored with your tax advisor as to whether in your particular circumstances it's advisable to file a 3520 for any US pension schemes that you hold. Nathan already very kindly touched on the treatment of the actual pension fund itself, again as a result of the UK-US double taxation agreement. The growth in the UK pension is outside the scope of US tax. So in the same way you would expect for a US pension scheme, the UK pension rolls up tax-free until you're ready to take that. I mentioned earlier the possibility of contributing more than the US limits to a UK pension scheme, and that often is possible through foreign tax credits. So if you have paid more UK tax than is necessary from a US perspective to cover the US tax due on professional and employment income, then you may be in a position where you can put a little bit more into your UK pension, because even if that isn't deductible in the US, it's not a problem because there'll be no US tax, and it will just simply allow you to use some of those foreign tax credits that have built up over years living and working in the UK. Again, it's something that's definitely worth reviewing and discussing with your US advisor as to whether that's an option for you as you move towards planning for your retirement. If I could have the next slide, please. So now it's time to move on and have a look at the position on US pension schemes. And obviously here more we're going to focus on the UK tax position. The US tax position is more straightforward. The tax deductibility of a contribution to a US scheme is a lot more clear from a US tax point of view, and the contribution limits are something that is easily referenced if depending on the type of scheme that you're contributing to. So again, it's more important to consider the options for making contributions to a US scheme from a UK tax perspective. Here again, the double taxation agreement does really help us here, because again, as with US tax relief on contributions to US pension schemes, it does provide for and allow contributions from a UK tax perspective to be deducted if they're made to US pension schemes. There are also sort of UK laws aimed at helping internationally mobile individuals continue to contribute to schemes in their home country. And this is really the key point, and I believe it's something that was raised on the chat already this afternoon, and that is one of the rules around being able to contribute to a US pension scheme is that you must have been a member of that scheme before becoming a UK resident individual. So you won't get tax relief on contributions to a US scheme opened after becoming UK resident from a UK tax perspective, unfortunately. Moving on now to tax considerations on the actual drawing of US pension income and receipt of US pension income as a UK resident. Again, the UK would generally tax on a worldwide basis unless you are claiming the benefit of the remittance basis. So you start from the point of view that you would be reporting the US pension income in the UK. Again, as we've already touched on, it would still be reportable in the US as well. And the double taxation agreement between the two countries does say that it's the country that you are resident in at the time of drawing the pension income which gets the main thrust of the tax due. So here you would expect, again, taxation on the pension income in the UK, and the US allowing a foreign tax credit for that UK tax paid on that pension income. Again, something we're often asked is people, as they plan towards retirement, want to consolidate schemes, or in conjunction with their investment advisor, are looking at a different plan that might perhaps provide them with better rates of growth, or for many other reasons, people look to move their pension scheme to another US qualifying pension scheme. And the UK tax position here would normally be that would be potentially taxable. But again, the UK-US double taxation agreement helps us out here and says that if this transfer would be exempt in the United States, which it would be, transfers between schemes are tax exempt in the United States, then it will be tax exempt in the UK as well. So it is possible from a tax perspective to consider rollovers between US pension schemes. That's something, as I say, we get asked a lot. And the same, although I didn't touch upon that in the previous slide, the same would apply in the United States on transfers between UK pension schemes. So it is possible, for example, to take an employer scheme and put it into a SIP or other personal pension, combine employer pension schemes, and just make your pension arrangements a little bit easier to administer without incurring huge amounts of US or UK tax as a result. Something a little bit different now that I want to touch on to those general principles is Roth IRAs. And the reason for that is obviously their different tax status from a US perspective, being, as Nathan rightfully pointed out, a bit more similar to an ISA than a UK pension scheme, in that they're tax exempt. They're tax exempt on drawing, but you don't get tax relief on the way in. The same applies in the UK to the treatment of Roth IRAs, in that if you roll over from a traditional scheme to a Roth IRA, it isn't a tax exempt transfer because it's not a tax exempt transfer in the United States. We then have to rely on another part of the double taxation agreement to say that because both schemes are in the United States, it is the United States tax rules that apply and not the UK. So again, this would not be considered a taxable transaction from a UK perspective. US tax rules would apply to this rollover, and it would be taxed obviously under normal principles in the United States. So again, it's something that would be considered, can be considered, and it can be considered by UK resident US citizens. You would apply the same rules as you would if you were a US resident UK citizen. Being in the UK doesn't make that situation any more complicated from that point of view. And again, I think, as I've already touched on, as a result of what is said in the UK-US double taxation agreement, although the UK has rights to tax US pension income for UK resident US citizens, they have agreed that if that US pension income would be exempt in the United States, then it is also exempt from a UK tax perspective. So hopefully that provides sort of some of the key answers that people might have in connection with US pension schemes that they hold. If I could have the next slide, please. So now, just as wrapping up this part of the talk, I wanted to just run through some other relevant tax considerations. On returning to the United States, obviously some of the rules that we've talked about here in connection with UK pension schemes will change ever so slightly. One big question that we get asked for someone returning to the United States, and in fact in general, is do I get the 25% tax-free lump sum when I draw from my UK pension income? And the short answer is yes, you absolutely do. And again, that's as a result of the UK US double taxation agreement. Again, when returning to the United States and you're no longer paying UK tax on your UK pension income in particular, it's always quite interesting for people because they are having to report their UK pension income in dollar terms, and that can, just for the sake of being aware, increase the tax liability a little bit by making the income a little bit higher than you would otherwise expect as a result of either effectively a weak dollar, so you're getting more dollars to your pounds, even though you may not be actually converting that income. It's also worth, because this comes up a lot, just very, very briefly touching on the estates and inheritance tax implications of plans in the other jurisdictions, and that is that it is not always the case that US schemes are exempt from inheritance tax in the UK. In fact, it's best to plan on them not being exempt from UK inheritance tax, and that is effectively due to the more rigid structure of US pension schemes, where you make a binding nomination of where the funds go on your death, different to what we do here, which is more you simply express your wish to your pension scheme administrators, and they are able to, in theory, accept or reject that. And that can make quite a big difference from an IHT perspective. So it's always worth being aware and asking a tax advisor to look over any US schemes that have significant value, and just seeing if there's any action that can be taken to minimise any potential IHT exposure that you might not previously been aware of. It's also worth, and that, just to deal with my final point, that's not overridden by the fact that we've got a UK-US estate tax treaty. Unfortunately, the UK, for UK resident and deemed domicile individuals, that would be the situation. It's also worth just very briefly highlighting that as well as income tax on withdrawals, we have, as Nathan touched on, other tax charges, such as the lifetime allowance in the UK and the early withdrawal penalty in the US. And we often get asked, are those coverable under the UK-US double taxation agreement? Do they get cancelled out, or can I take foreign tax credits? And unfortunately, it's best to work on the basis that the answer is no. Neither HMRC or the IRS will be drawn specifically one way or another, but all the indications are that they don't, except in very specific circumstances, see those as being reduced by the effects, offset by the effects of the UK-US double taxation agreement, or usable as a relevant foreign tax credit as appropriate. That concludes my section of the talk. Obviously happy to take questions, as Nathan's already mentioned. And now I am going to hand over, I believe, to Brian for Dunhill's section.
Thanks so much, Gillian. That's a great section. And very informative, very helpful from a tax perspective. And with all those tax considerations, we'll delve right into how we conquer those types of things when it comes to building the investment portfolio. You know, as Gillian talked about, we can use the different segments, whether it be a US-based account in an IRA or a Roth IRA, or the SIPs and the ISAs in the UK, which can lead to some complexities. But we'll start with the main aspects that we need to deal with. And that's to make sure that they're both compliant in the US and the UK. So Cam, if we can go to the next slide, what we really want to concentrate on is that we don't ever buy non-American securities. So we don't want to buy British UCITS or any other instruments outside of the United States, because they'll be considered PFICs, passive foreign investment companies. These are a really expensive way and a really tax burdensome way of investing, and that's why we suggest not doing so. If you buy an individual stock in a UK-based account or an individual bond, it most likely won't be a PFIC, but if you buy any form of collective, including an ETF in the UK, it will, and it will make your taxes a lot harder on the United States side. So we always suggest buying everything in the United States and buying either individual stocks or ETFs. We stay away from mutual funds. Now, some mutual fund companies will still allow you to purchase a US mutual fund with a UK or a European address, but we've had new MiFID regulations come into place in the last couple of years, and the UK is still part of the European Union at this point in time. And after they leave the European Union, they will collect that law for a period of time. We don't know if they'll amend it, and therefore collectives outside are not to be permitted. So we would suggest staying away from mutual funds for the most part in the United States. Some companies will interpret ETFs as a no-go zone, but for the most part, when we read through the MiFID regulations, there's no actual reasoning why it shouldn't be. So that's a brokerage decision, something to consider when you're trying to figure out who you want to invest with. But an important consideration when you're in the UK is that you want HMRC compliance or UK reporting status. This is important, especially when it's outside of a retirement account, because that will give you a special tax consideration. It also limits the number of investments you can have. Any individual stock or bond will automatically be in there. But when you slim down the list of all the ETFs available in the United States, there's probably only 80 or 90 US securities that are on the list that are HMRC compliant. This means that it will be taxed at 20% instead of your regular UK tax bracket. So it can be a large cost savings to you to make sure that you're conforming in the US to avoid any non-US securities, i.e. anything that's registered in the UK, that you're conforming with MiFID requirements by not buying US mutual funds, and that you're with a brokerage that allows you to buy ETFs, and that you're also buying HMRC compliant ETFs in those portfolios. So lots of things to consider. That shrinks down the universe that we can buy into. And this is where we get into our portfolios, and we'll go into on the next slide. When we consider what we should, I'm sorry, Heidi asked, what's an ETF? I apologize for throwing out too much jargon. An ETF is an exchange traded fund. So instead of having a manager that's managing a UCIT or a mutual fund in the United States, and they're buying individual securities trying to beat the markets, an exchange traded fund typically will be passive, and it will try to mimic an index. So for instance, the biggest, largest exchange traded fund in the United States is the SPDR, which the SPDR mimics the S&P 500. So the S&P 500, biggest 500 companies in the United States, it will passively mimic that by buying those exact 500 securities, but that keeps us from having to go out and buy a big group of stocks, and it keeps the fees real low. The Vanguard 500 is on that list, but the SPDR is not on that list for HMRC requirements. So that's where these are the tools that we want to utilize. So we want things that are domiciled in the US, but reporting in the UK. We can hold shares directly. If we have a US-based account, we will not have to file an FBAR for those accounts. The FBAR being an old tax reporting system, actually is a reporting to the Treasury, not the IRS, sorry, so it's not even a tax reporting, that Nixon put into place, the Nixon administration. The FBAR is a report that you have to do each year for any time that you have collectively more than $10,000 in aggregate across all of your foreign accounts. So it doesn't matter where they are, if you have collectively more than $10,000, you have to report. For these investment accounts, since they're sitting in America, you don't have to do that FBAR reporting. If you also have a US provider, you'll get a 1099 reporting. This makes completing your taxes with Gillian or any other tax advisor much easier, even to give some people the opportunity to do it themselves, because all the numbers are right on the front page, and listing of what's required for dividends, capital gains, losses, everything else that you might need. Now, when you're designing your portfolio, we can think about what should be inside of there. And on the next slide, we're going to talk about the allocation for those. So what are we doing in our portfolios? We are trying to get a little bit more diversification to where we're going to need the funds. So what you can tell is the burgundy, our firm color, is a lot larger for the US dollar model than it is for the euro or GBP models. This is natural hedging to that currency. So if we have an American that's in the UK, but going to retire back to the US, we want to try to minimize the currency risk of the US dollar moving against them. So we would want to invest more of our securities in US dollars. Hence, we'd go with the USD model. If you're in the UK now, but you intend to move down to the French Riviera, we might use the Euro model. So we decrease the US dollar exposure and increase the Euro exposure. Or if you intend to remain in the GBP in the United Kingdom, we'd increase the GBP allocation and reduce the US dollar allocation. This is called natural hedging, and it's a typical exercise that everybody uses. And just to put into consideration how big these differentials are, the typical US allocation will have 80 to 85% US dollars in it. That doesn't matter if you're using Wells Fargo, Goldman Sachs, UBS, Morgan Stanley, all of the shops use the same similar allocations. That compares to if we just took an even weight of the market cap distribution of all different countries, you would normally be just over 50%. So that 35% differential is a reduction of risk by buying in your currency. In the UK makes up about 2 to 3% of the world's market cap, but you'll probably see 35 to 45% in British securities, no matter what firm you're going with, whether it be a UK registered firm or whether you're using a US player to buy a UK like portfolio. And in Europe, it'd be 14%, but we're trying to get 45 to 50% exposure. So that's all we're trying to do, is build an allocation that would look like what any of your main investment houses in the UK would build, but building it in the US. So not reinventing the wheel. Now, if we go to the next slide, you'll see that we have plenty of different portfolios to choose from. You can go directly to our website and you can actually get to the different fact sheets for all of these different portfolios in 6 different risk metrics. If you're not sure what risk metric you should be in, there is a risk calculator on there, or you can go directly to Nathan and he'll be able to help you in selecting those different portfolios in those different currencies. And we have a full guide in the US Select service that will get you answers to how we build those and all the different aspects of it. Now, most of our portfolio is in the core holdings. So the pieces of the portfolio that should remain in there over the course of time, i.e. a lot of our US allocation will be in the S&P 500. A lot of the UK will be not in the FTSE 100, but we use a thematic that will grow a little bit faster. And if we go to the next slide, essentially what we also have is 20% of our allocation that goes into what we call satellite positions. If you want to understand our Core Plus satellite approach, if you go to our YouTube channel, Dunhill Financial, put that into YouTube, you'll get a new video on the Core Plus satellite approach. But basically, we're looking at certain shorter term positions, which can only ever get to 20%, and 80% into core positions, which are made up by those big indexes. Now, we talk about these in our economic update, which we just had a new one last week since it's a new quarter. And with that, essentially, we have a full update there on YouTube, but I'll give you just a few little blurbs, because with all of us that are sitting in the UK, well, I'm not right now, but I'm normally sitting in the UK, we have the opportunity to have 2 big events that are going to move currencies in big ways. We're going to have a presidential election in less than a month, and Brexit maybe in the next couple of months. Both of these would expect to move the currency markets in big ways. The last 10 years have been easy, and if you've been in a US dollar portfolio and yet living and planning to retire in the UK, you've had a great time because the dollar has been appreciating compared to the pound. The last 4 years, the pound's been going down since the Brexit vote. Now, longer term, we would expect the dollar to normalize and go down. It's been overvalued because of a flight to safety. We expect this. We see this every time that we have a major event like this pandemic or like the financial crisis. So the last 10 years have been great for us in two regards. If we've had an over allocation to US dollars, the next 10 years are going to be a little bit more difficult. Hence, if we reduce that risk, that currency risk, by having a bigger portion of pounds, we don't have to worry about it so much. We know with these big two events coming up in the next couple of months that we would expect the dollar to go down, but it can't really go into euros or pounds because of Brexit risk. And that's to where we've taken on more hedges to our portfolio than we've ever had in history. I spent 20 years of my career saying that gold is not the place to be. And last August, we started making an allocation as a hedge to currencies, not to stocks, but to currencies in gold. We've even added small positions into silver. And now we're even going to the next extent of adding renminbi, which are the Chinese currency, and adding that piece as a hedge to our portfolios, just in case our three major currencies go down at once. I'll be ecstatic if all of those hedges go down in the next year. And most of all of our clients will be as well, because they're only there as hedges. But what we want to make sure of is that we consider all types of situations in this economy in these odd times to make sure that if we have groundbreaking changes in how currencies move, which we expected in the long term, but they're happening in the shorter term, that we're ready for those changes. So please feel free to check out our YouTube channel. I'll stick around for Q&A. I see that there's a few questions here, but I don't want to encroach on Marylouise's time, and we'll get to those questions after Marylouise's presentation.
Hi, Nathan, Brian, and Gillian. Thank you very much for inviting ACA. Today, I'm going to speak to you about what ACA is doing here in Washington, D.C. To help make life easier for Americans living and working overseas, and those of you in the UK. So we can move to the first slide there that gives you a little bit of background about the organization. We were founded in 1978, so we've been around 40 plus years. We are nonpartisan, which is hugely important because all our issues deal with just good policy as opposed to supporting any sort of political position. ACA, for a long time, when we were located and headquartered in Geneva, Switzerland, because two of our founders started the organization there. We used to do door knockers, which is an annual visit to Congress. A lot of organizations and groups do this. And we found that over time, we were coming more and more frequently to Congress, and that it was really important to have a presence here and to have our headquarters here and to be available to the Congress. So we created two official organizations, nonprofit organizations, one being ACA Inc., which is a 501c4, and that's our advocacy organization. And then we have an educational research and fundraising branch of the organization, which is ACA Global Foundation, a 501c3. So if we go next to the next slide, what are the advantages of ACA? And the big advantage is that we're headquartered here in Washington, D.C. And that's really important because the problems come from you, the community, but they need to be addressed in Congress. And it is important that we are here and we are available to the Congress, where they can come to us for information, education on issues, and we're here to be able to go up at a moment's notice and have a meeting. So we also look at the landscape and we can analyze the problems and put forth practical solutions. We hear a lot of people say, repeal this, do that. That sounds easy, but it doesn't really happen that way in Congress. So we try to work with the reality and provide solutions that are practical, that we can think we make happen. That gives us a lot of respect with the leadership and with stakeholders here. So we're building relationships with other like-minded organizations, in particular organizations that are working on tax reform and regulatory reform. So if we go to the next slide, this just shows you a lovely, lovely room up on Capitol Hill that we often meet in, but not right now with COVID. So we can talk about some of our advocacy work. Next slide. So as you all probably are familiar, if you've spent any time on the ACA website, you know that we are advocating for residency-based taxation. And this basically would exclude income that is earned outside of the United States or not in relation to the United States from US taxation. So what ACA has done, which is a really important piece of work, is we took the current code, and right next to it, we said, where do you need to cut into the code to make it residence-based? ACA's charge is not to develop legislation. We're not putting proposals in front of the Congress. That's the Congress's job. That's the tax writing committee's job. What we told them is, here's how you can get there. We also funded research through ACA Global Foundation that gave us some essential data on the size, the income, the investment structure of the community of Americans overseas. And all of ACA's data has been presented to key committees, not just congressional offices, but committees like Joint Committee on Taxation, Senate Finance, House Ways and Means. And for those of you who may not be aware, those are the committees that will do the work. They do the number crunching. We also supported Congressman Holding's bill, the Tax Fairness for Americans Abroad Act. I don't know how many of you are familiar with that piece of legislation that was introduced, but we worked closely with Congressman Holding's office on that. We have a write-in campaign for hearings. I'll talk a little bit more about that. We really feel it's essential at this point to have hearings. And obviously we're using all the effects of legislation like the transitioning tax and GILTI regimes, the tax implications of PFICs that Brian just spoke about, even the CARES Act experience as support points for a move to residence-based taxation. So we can move to the next slide. So yes, we do more than just tax. Obviously, we're keeping an eye on all the different tax provisions. As I mentioned before, the transition tax and GILTI. We immediately highlighted those problems. We immediately asked to testify to the IRS, and we put forth what we think is a practical solution, which is a de minimis ruling, which basically is you decide at what point small businesses, whatever that figure is for small business, and you remove them from the reporting of this legislation. So FBAR and FATCA, ideally FATCA would go away with residence-based taxation, but in the interim, there's a very simple and easy regulatory fix that the Treasury could put in, that same country exemption, which would essentially exempt from an American who's legitimately living overseas and has an in-country bank account that's not offshore for him, that's his local bank account. It would remove that bank account from the reporting cycle, and also the bank would not have to report on that. And that's an easy fix. And actually, in the last administration, we were very, very, very close, we think, to having Treasury write that in. And we think it just didn't happen because of the elections and the new administration coming in. We're also keeping an eye on the passport revocation provision. There is a provision out there that says that you could have your passport denied or revoked if you have a tax debt. That we understand what the Congress is trying to do domestically with that, so that they, do not have an individual abscond who has a tax debt. However, a passport, as we all know, for an American living and working overseas, has a much different place than a passport does for someone living domestically. If you're overseas, it literally is the only official proof that you are a US citizen. So we're asking for safe harbor for Americans overseas on that. Also, Social Security, a lot of issues here with creating online accounts, difficulties in procuring Social Security numbers. There are individuals out there who either never got one or may have been born overseas, and their parents may have applied for a birth abroad, but never a Social Security number. We are also working on advocating for the removal of the windfall elimination provision for foreign pensions. This is a provision that will reduce your US Social Security benefits if you are drawing from a foreign pension. And obviously, we think a lot of the totalization agreements should be expanded. These are agreements between countries where they recognize the US Social Security or US contributions. So those are rather not limited, I would say, but haven't come into the modern age, let's say, in a lot of countries where there are Americans doing business, there's no totalization agreement, and there really should be. So our next slide. So how are we working in the world of COVID? So there are not a lot of meetings going on up on Capitol Hill, and we are following up with conference calls and direct one-on-one calls with congressional offices. Again, we are collecting up all the CARES Act experience. We're using that as support points for residence-based taxation. Some of you who are on this call may have run into this problem trying to use the Get My Payment tool, which allowed you to track your payment. There was a problem with inputting your direct deposit information if you wanted to receive the stimulus by direct deposit, not physical check. Small US businesses overseas could not fully access the CARES Act relief because you needed to be based in the United States or have a payroll out of the US. And then the issue of joint filers, where the joint filer did not have a Social Security number and had an ITIN, and that disqualified them from the stimulus. So we're using that as another support point. We continue to meet with the IRS and Treasury and State Department on better outreach to the American community, and also highlighting the problems that are out there. We are monitoring write-in campaigns. We have a campaign asking for hearings. We truly believe that hearings is the next step to tax reform, to Congress writing legislation. It makes it very official for Congress when things are put on record through hearings. We recently wrote to Senator, I think there's a misspelling there, how awful, Markey, and Representative Castro. There's a piece of legislation that they drafted. It really concerns Americans who wanted to repatriate because of COVID. However, it does acknowledge that there's a community of Americans overseas. And then the four senators, Feinstein, Klobuchar, Menendez, and Wyden, also wrote to U.S. Secretary of State Pompeo about better outreach for the U.S. embassies. So we sent a letter out reinforcing the messaging that it should not only be during an election year and a time of pandemic that the Congress turns its attention to Americans overseas. We need to have hearings. These problems need to be put on record. And we're also cultivating partnerships with organizations, as I mentioned before, here in Washington, DC, AmChams, other tax reform organizations working on tax reform. Next slide. So our campaign to call on hearings. Again, as I've mentioned a couple of times, we firmly believe that hearings are the next step. We have a write-in campaign that you can go to on the ACA website, send in the messaging to your representative, and it also goes up to the members of the House Ways and Means Committee Select Revenue. And that is the committee that deals with writing, reviewing tax legislation. We've had over 16,000 messages gone in. We follow up with a lot of the offices where the messaging has gone into. A lot of those offices know us very, very well. We've been back in there several times. And again, hearings don't slow down the process, and they're very, very important and critical because it puts all of ACA's data, all the good work of other organizations that's out there, puts real people in front of the Congress, puts it all on record. So the Congress can no longer say, you know, we think, yeah, we hear anecdotally, there's documentation, there are submissions, even if people don't attend the hearings and testify, submissions can be put in there, and the Congress can go to that and say, no, there's actually a real problem because this organization did some research and we know that there's a problem, we've got to fix it. Next slide. So voting, ACA's done a lot on voting this year. Every election cycle, we go out there and remind people that it is important to vote from overseas. Your vote does count. It's not just in a tight election that it's counted. They actually do count your vote. We also have a campaign where you can ask those running for office their opinion on your issues. So you can go on our website and send in messaging. Do it soon, because obviously there are deadlines coming up for requesting ballots and getting your absentee ballot. We also did 2 5-day challenges that talked about everything you need to know about registering and requesting your absentee ballot, and also about the history of getting the vote from overseas. So prior to ACA being created, which was one of the things that launched the organization, the 2 founders worked on getting the vote from overseas, along with a lot of other individuals and a lot of other organizations that were out there at the time. So a lot of people worked hard to make that happen. So please go and vote if you can. Next. So a few services that we have for Americans overseas. We have the Expat Tax Services Directory that has listings of tax preparers and financial services. A thing to remember is that even with passage of residence-based taxation, Americans overseas still need professional services, in particular, Americans who may have assets back in the United States. There may be a need for wills, there may be a need to manage US assets, a US small business. So there's a lot of resources in our tax service directory. Next slide. The ACA member SDFCU accounts. So many of you have been overseas probably a long time, but what I like to tell people who are considering moving overseas, the first thing they should do is get a State Department Federal Credit Union SDFCU account through ACA. This is a bit of a guarantee that you will have a US-based bank account. As many of you probably know, given the rules of and regulations of Know Your Client out of the Patriot Act, a lot of US banks and financial services have become very cautious about who their US client base is, and they want to know that you are residential in the United States. And it can't just be a post office box, it can't just be your cousin's address. They want now to see that it's really you, that you are really tied to that residence. They want to see a utility bill. A lot of people confuse this and think it has something to do with FATCA. It really doesn't. It has everything to do with the Know Your Client regulations. So we've seen a lot of Americans have bank accounts and financial accounts in the US locked or completely closed, denied. So this with SDFCU gives you banking services. They have lines of credits, IRAs. They can receive US deposits. You can make payments. You can use Zelle if you're making payments within the United States. So this is a great, great product for all Americans overseas. Next slide. I think we're close to the end. So getting the word out, how do we get the word out? We work with stakeholders here in Washington, D.C. and other organizations, and we're out there in the media quite a bit. We're issuing press releases. We do direct engagements with journalists. And in fact, last week, I did a short little piece on the BBC, so that I can send Brian the link if people are interested in listening to that. It was part of a larger discussion about the US elections. We use Facebook and Instagram and Twitter and all the social media, and our website is a huge portal of information. We also have started a series of ACA podcasts, and these touch on a lot of subjects, not just tax. What we find is that, obviously Americans overseas are very concerned about tax. They know that ACA is, the premier organization here in Washington, really doing the day-to-day work, but they do have other issues. They do have issues, family issues, looking for resources for children that may have special needs, schooling, a lot of other topics and issues of interest. So we've been doing every second Tuesday of the month a podcast. So check our podcasts. This month we're going to be talking to Lindsay Bach, who is a global nomad. So it's going to be really interesting podcast on that. Next slide. So just a couple things to remember when you retire overseas. A lot of this was a lot of the tax things were already covered by Nathan and Gillian and Brian, but the foreign earned income exclusion cannot be used to offset U.S. taxation on retirement income. Medicare is not available overseas. Medicare benefits for individuals who paid into Medicare are not available. You need to come back to the US for those services. And for individuals who have paid into Social Security, as I mentioned before, with the windfall elimination provision, there is a potential that your foreign pension will affect or reduce your US Social Security benefit payments. And then the last slide, I think, just has a few links to how you can help our advocacy efforts. Visit our, 2 websites, join the write-in campaigns, and join ACA, join and donate ACA, because it's only through membership and donations that we're able to do our work. We are mostly volunteer outside of a small administrative staff, so we really count on memberships and donations. And thanks again, everyone, for inviting ACA.
That's great. Thank you very much, Marylouise, for that. That's a great run through. Cheers. I think Cam has been monitoring the chat as we've gone through there, and will have pulled out some questions for us to answer. Cam, shall I hand over to you and let you steer us on where to go with the questions, please?
Yeah, thank you very much for that presentation, Nathan, and to all our guest speakers. We've got a few questions here, so I'll just pick them in no particular order, and perhaps one of our panelists could answer them. So we've got a question from Heidi. So they mentioned that they've opened an IRA with Vanguard after they became a resident in the UK. Will this cause problems later on down the line?
Just picking up on that one, and I thank you, Cam. I did drop an answer, or I believe we did mainly address this in our chat, although Heidi has, I think, just confirmed it's actually a Roth IRA. In that case, the answer is you wouldn't be getting any tax deductions anyway. So for a Roth IRA, no, it doesn't actually make any difference whether it was opened prior or post arrival in the UK. It's only where you are looking for a tax deduction on the IRA that you would want, from a UK tax perspective, to have been contributing and have opened the plan prior to becoming UK resident to be able to continue to get tax relief on contributions you make once you're here. But obviously, as we talked about, that's not relevant with a Roth.
Perfect. Thank you for that answer, Gillian. We've got another question from David. I've always avoided ISAs in the UK as they are liable to tax in the UK. Is that correct?
Again, I'm happy to take
this.
jump in both Brian and Nathan. It really depends on your individual tax position. They should definitely still be looked at, specifically for higher and additional rate taxpayers here in the UK, because although they aren't tax advantaged in the US, with US tax rates on qualified dividends being a lot lower than we charge here, and obviously our 40 and 45% rate of tax on income, they can still work quite well in those circumstances, but you would need to be working with someone who knows what investments can and can't be held within that ISA for a US citizen to avoid the lovely PFIC situation that we touched on earlier.
And I think that's a perfect segue, Gillian. So our portfolios, we only have 3 ISA portfolios because the HMRC will only allow us to buy individual stocks inside of an ISA. They won't allow us to buy those ETFs, which they will in a general investment account. So that means that we only have more aggressive portfolios. And while a typical non-American, the ISA becomes the foundation, first place to start investing. When it comes to an American expat, we would typically say that they should avoid it to try to get more diversification, and it should only be somebody that has a bigger portfolio surrounding it that would go into the ISA, because we would have to build that with individual securities and get diversified through that way. So that being said, we end up having those portfolios that are accessible for you. The cash ISAs are becoming a little less attractive with interest rates going down. We even had an inquiry in the last week that said that one of the providers had gone to negative rates in the UK. Nathan, you'd be more apt to say whether that's the usual of what we should be looking at. But with it being taxed in the US and not in the UK, like Gillian said, it's great for high earners, but for the regular common person, it's not necessarily the answer for every single American expat. I put a link to an article explaining a little bit more of that that we wrote on LinkedIn into the chat, so feel free to take a look at that. Thanks, Kim.
Yeah, so I'll just touch on that, Brian, and kind of echo everything that you've said there. And I think the important thing as well for people to think about with the ISA is that if you're constrained to obviously putting £20,000 into that ISA and trying to make that a well diversified multi-asset portfolio, that's going to be quite a struggle. So it is to be viewed as part of a broader investment plan rather than a standalone solution. That said, it could be used in earlier stages of your planning for your cash savings element. Yes, cash savings interest rates are extremely low. However, if you are building up some cash savings, perhaps just as an emergency buffer or something like that, with a little bit of digging around, it is possible to get slightly better cash interest rates through ISAs rather than just having it in your regular current account. So that might be worth thinking about from that point of view.
Perfect. We've got our next question from David, and I think Marylouise, you might be more suited to answer this. So David asks, what was the name of the bank for the American overseas, and could you maybe give a little bit of another brief rundown of how that's beneficial to US expats?
So sure, I'm happy to do that. So if you go to the ACA website, you will find a prompt for the ACA member SDFCU account. So ACA, through ACA's membership, it's not ACA that provides the account. We are a qualified organization, and therefore the State Department Federal Credit Union, SDFCU, can offer a bank account to our members, because you need to come through a qualified organization. Now, the SDFCU is not linked to the U.S. State Department. Credit unions are owned by their members, and it was created by the State Department federal employees, because at the time they are and continue to be a very mobile population. They move around the world quite frequently, live overseas, may not have a residential address. So it was created for that community. So they understand the global community, and they understand Americans overseas who don't have a residential address back in the United States, who don't have a lot of ties to the United States, may not have a lot of financial history in the US. So there's no guarantee you will get an account with SDFCU, but when you apply online, and if you go to our FAQs, you will see what they require for you to present. They do need to do some due diligence. They need to verify your identity, although they don't need to do the same due diligence, say, as a stateside bank. And they have a whole list of services. Like I said, they have IRAs. You can, for a lot of individuals who have been locked out or had their IRAs frozen, say in the Fidelities of the world, they're able to roll those over. They have lines of credit. You can get a mortgage for US property. You can get a bank account, a savings account. So I would recommend that you take a look at our website, find the pages there. I can send the link to the actual page and to the FAQ page to Nathan, and maybe he can send that around to everyone. But take a look, and if you have any questions, let us know, or you can ask, there's an email where you can ask the State Department directly if you have a particular product that you're looking for or need for the bank account.
I hope that answers the question. I think due to time constraints, we'll pick probably one more question to go through, and then before handing it back to Nathan. We've got a question from Charles. I'm not sure if he's still around, but he mentioned that virtually all of the retirement savings that he has, or she may have, is in a US 401k, but her husband is saving in a UK stakeholder plan. She's concerned about how to coordinate these separate investments and how they may impact the survivor and minimize tax consequences. Not sure who this question applies to, but I'll let any of the panelists take a stab at that one.
Nathan, do you want to go first, or would you like me to jump in?
Yeah, I'm happy to chip in there initially, and I think this probably kind of talks to a lot of considerations around this, in that over time you collect different retirement plans and savings and different investment accounts all over the place, and it can be a little bit challenging, I guess, for everyone to keep on top of those and manage them in a coordinated process. I think one of the key things that you've got to do is understand really what you've got in each one individually. Look through them and see what's in there. The UK plan, as Brian touched on in the investment part earlier, it's likely to be very UK focused in its holdings and its investments, whereas the US 401 will more likely be very US focused. So you'll need to think about how those two come together, and whether that gives you the kind of holistic position that you really want to achieve, dependent on where you might retire or not.
The only thing I'd add to that would be two things. First of all, you should be talking to somebody like Nathan that has expertise on both sides of the pond, because by doing that, it's easy to coordinate it. And Nathan is very good at those types of things. The second thing would be also consider estate taxes. When it comes to estate taxes, it might be a generational thing. Both jurisdictions look at spouses as being able to pass over wealth, but that can change on the American side if you have a non-US spouse, or if both of you are non-US. All of a sudden our exemptions go from 11.4 million down to 60,000. And then it could be a consideration to try to make sure to reduce that US retirement account as fast as possible without taking on too many tax burdens. So many things to consider. It's most important to prioritize those, but definitely talk to somebody that has the experience on both sides, like Nathan.
Perfect. Yeah, thanks for those responses. Hopefully that answers your question, Charles. I think that's it for the Q&A section, ladies and gentlemen. So I'll pass it back to Nathan for the closing remarks.
That's great, and thank you to everybody for joining us today and for asking those questions as we've gone along. Obviously, we've got up on the screen here, as well as everybody's wonderful mugshots, our contact details. So please do reach out to us with your questions. It's not necessarily something that we specifically are best to answer. We'll direct it to the right person. So just pick a face and reach out. As I said at the beginning, we will send around a link to these slides and the presentation so that you can review them back. We'll also include in there some links to some of the key guides or previous webinars that we've spoken about as well. On that note, I'll thank you all very much, and we'll end it there.